Would you like to invest in the same business model that propelled Warren Buffett to billions of dollars? Want to take advantage of one of the most powerful competitive advantages out there? Want to collect market-beating passive dividend income? While you do so, then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out, grow the channel. I'd really appreciate it. I want to tell you about a high-quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing valuable insurance products that protect people from catastrophic loss. Warren Buffett recognized the potential of insurance decades ago and used the power of what's called a float to build up a massive fortune. The insurance company I'll tell you about today has built up an investment portfolio worth over $70 billion with other people's money. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Travelers Companies Inc., which appear to be trading at a significant discount today. Travelers Companies Inc., stock ticker TRV, is a holding company that through its subsidiaries provides commercial and personal property and casualty insurance products to individuals, businesses, government units, and associations. Founded in 1853, Travelers is now a $29 billion by market cap giant in the insurance space, employing over 30,000 people and doing business in 4 different countries. It's the only property and casualty insurance company in the Dow Jones Industrial Average, which shows its blue chip colors. Net written premiums for fiscal year 2019 break down across the following segments: business and international insurance 54%, personal lines 37%, and bond and specialty insurance 9%. I mentioned competitive advantages at the outset of this video. Insurance is a classic example of built-in profit. Whereas a lot of people might think insurance companies make their money off of the premiums they charge for their insurance, that's actually not the case. The true source of an insurance company's profit is the float. This is the capital that builds up as a natural course of doing business. An insurance company charges premiums up front, and they later pay out claims against those premiums. But the lag between these two events often leads to an insurance company sitting on a lot of cash, which is a low-cost and low-risk source of capital that earns returns. It's somewhat similar to a bank deposit scheme. For perspective on that, Travelers manages an investment portfolio worth over $77 billion as of the end of fiscal year 2019. That portfolio is more than twice as large as the company's market cap. Adding further color, Travelers had net income of just over $2.6 billion last fiscal year. The investment portfolio propelled most of that, with net investment income coming in at over $2.4 billion. The float is what makes the insurance business model so lucrative. Warren Buffett recognized the power of the float decades ago, heavily investing in and later buying out Geico. Buffett took the inherent competitive advantage of a float and supercharged it by virtue of his investing prowess, building a $200 billion common stock portfolio in the process and becoming arguably the world's all-time greatest investor. This inherent competitive advantage tends to lead to a lot of profit and dividends. Indeed, Travelers has increased its dividend for 16 consecutive years. The 10-year dividend growth rate is 10.1%, which is really solid when paired with the stock's starting yield of 3%. That yield, by the way, is 80 basis points higher than the stock's own 5-year average yield. And with a payout ratio of 48.6%, the dividend is secure. Looking at business growth, Travelers grew its revenue from $25.112 billion in fiscal year 2010 to $31.581 billion in fiscal year 2019. That's a compound annual growth rate of 2.58%. I would say this is good, but it's not excellent. Meantime, earnings per share climbed from $6.62 to $9.92 over the same time frame, which is a compound annual growth rate of 4.6%. A startling 45% reduction in the outstanding share count over this period is what led to the excess bottom line growth here. A decade of aggressive competition in the P&C space has left fewer opportunities for profitable responsible underwriting. Recent years have saw a string of large-scale natural disasters damaging profit further. Moreover, low interest rates have hurt the company's ability to earn an attractive return on its investment portfolio. And then you have the business coming out of a major recession back in 2010. This is probably the toughest decade you could possibly throw at Travelers, yet they still put up some pretty decent numbers. Looking forward, CFRA forecasts that Travelers will compound its earnings per share at an annual rate of 6% over the next 3 years. They note an immaterial amount of risk from COVID-19 related claims, but lower demand for insurance in general due to a contraction in economic activity from the pandemic will be felt over the near term. In addition, low interest rates are pervasive and appear to be more of a long-term systemic issue. However, CFRA also notes prudent underwriting, strong buybacks, and the above-average balance sheet. The company had a combined ratio of 96.5% last fiscal year, proving out that prudent underwriting in a tough environment. It's about as quality as it gets in the P&C space. I think a 6% growth forecast is appropriate if cautious. I've looked at Travelers many times over the years and they've historically compounded their earnings per share closer to the 10% range, so 6% is already a pretty steep drop from that, which factors in many of the issues that now confront Travelers. Still, with a starting yield much higher than the recent average and with expectations now so low, it wouldn't be difficult to muster an appealing long-term result from Travelers. Moving over to the balance sheet, the company has a rock-solid financial position. It's common in the insurance space to maintain a conservative balance sheet due to the assumption of risk. The long-term debt-to-equity ratio is 0.23, while the interest coverage ratio is over 7. Their credit ratings are well into investment-grade territory. The company's senior debt has the following ratings: A from Standard & Poor's, A2 from Moody's, and A from Fitch. The investment portfolio itself is also conservative. 94% of the investment portfolio is in fixed maturity and short-term investments, and 43% of the carrying value is exposed to fixed maturities with a credit rating of AAA. Profitability is robust, although the competitive nature of the industry does constrain the business somewhat. Over the last 5 years, the firm has averaged annual net margin of 9.43% and annual return on equity of 11.39%. This is a well-run business and a blue-chip stock. With the inherent competitive advantage that is the float, it's an attractive industry to expose oneself to. And when looking at Travelers specifically, its scale and ability to spread risk allows for prudent underwriting and a strong competitive position. Of course, there are risks to consider. Competition, litigation, and regulation are omnipresent risks in every industry. Natural catastrophes are always a risk for any insurer, and the volatile nature of disasters can make it difficult to properly underwrite policies. Low interest rates limit profit for the company's investment portfolio, and with the company's exposure to municipal bonds, that means it faces risk of defaults if the finances of governments worsen. Overall, I see this Dow Jones component as a low-risk, blue-chip stock that can make for an excellent long-term investment, and the valuation appears attractive after a 25% drop from the stock's 52-week high. The stock is trading hands for a price-to-earnings ratio of about 16.5, and that's off of depressed earnings. That's certainly much lower than the broader market. Then there's the price-to-book ratio of 1.1, which is notably lower than the stock's 5-year average price-to-book ratio of 1.4. We can also see the price-to-cash flow ratio, which at 5.2 is disconnected from its 3-year average of 8.9, and the yield, as noted earlier, is significantly higher than its recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. This dividend growth rate is quite a bit lower than the company's proven dividend growth rate over the last decade, and with a low payout ratio, large dividend increases would seem likely to persist. However, I'm also factoring in industry headwinds, the CFRA earnings per share growth forecast, a severe economic contraction, and the fact that much of the previous decade's dividend growth was fueled by an expansion in the payout ratio. The dividend discount model analysis gives me a fair value of $121.27. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Travelers as a 4-star stock with a fair value estimate of $144. CFRA rates Travelers as a 3-star hold with a 12-month target price of $126. I came out on the low end here. Averaging the 3 numbers out gives us a final valuation of $130.42, which would indicate the stock is possibly 13% undervalued. Here's the bottom line, guys. Travelers Companies Inc. is a high-quality blue-chip stock that benefits from one of the most powerful inherent competitive advantages out there. With a market market-beating 3% yield, low payout ratio, 16-year track record of dividend raises, and the potential that shares are 13% undervalued, this could be an opportunity to invest like Buffett at a discount. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, be sure to check the description box below for some important links, including the link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.